with Financial Renaissance with the M's, and I've got my guest, Rob Tamburri, sitting here with me. Rob from Strong Island.
Strong Island.
You know what it is?
No.
What? That's Long Island, dude.
That's Long Island, of course.
Strong Island. Oh my gosh. She still has the accent, but has no idea. He's clueless.
That's right. It's been 24 years now in Atlanta.
Yes. So this is your 24th anniversary this month?
Yes.
So you're officially, I think at the 25th year, you officially become an ATLN and you get like a peach card.
Correct.
Right?
Exactly.
And you get free peanuts, free boiled peanuts.
That's correct.
That sounds gross. I'm not a Southerner. I'm so not a Southerner. But listen, this week we had something really crazy happen on the 285 freeway. And for those of you around the country who have no idea what the 285 is, in Washington, D.C., I believe they call it the Loop.
Correct.
Okay. So it's the 485 or the 4 something. In Atlanta, we have a highway that goes completely around the city, and you never see the city from this highway. Nobody likes being on it. But for some reason, last week, an armored car was driving, and the doors flew open, and $175,000 flew out on the freeway. And like a dream. No accidents happened. Everybody moved over to the right-hand side of the shoulder like they were supposed to, and they started picking up money. Now, here's my issue with all this. The Dunwoody Police Department want that money back. I don't know as of today, what the total is as far as what people have brought back, but I think as of a few days ago, it was about $4,000, between $4,000 and $6,000 that people had voluntarily, brought back to the police department. But here's my issue with all this. What if you were at home that morning and you said, I'm having trouble paying my bills? And the light bill is late, my mortgage may be late, et cetera, et cetera. God, show me a sign. The universe, show me a sign. Tell me what to do. Show me something. And you're minding your business and you're driving, and then all of a sudden an armored car door opens up and money flies out. Isn't there a conflict right there? So is it the police that you listen to, or do you listen to your God?
That's a tough one. I think the uniqueness of that situation and the fact that the armored car company is probably insured means that most of that cash is probably not getting back. Although, it raises issues of morality, obviously, and whether you feel like you want to return that. But I doubt they're going to see most.
But that's my point. From a morality and an ethical standpoint, if you said a prayer that day, the night before, to your, into the universe, like, help me out. I just need, if there's some way, somehow, this and this happened. And then that happens, like, ethically and morally, I feel like there's a gray area there. Like the police are saying, bring this back. But my argument would be God gave this to me.
And as a CPA, I can tell you the bad news for these people is that income is completely taxable. Right? The IRS does not care, even if it's from illegal activity, which is specified in the code, that money is taxable. And if they put it in their bank account, they've definitely memorialized it.
Well, how is the money, first of all, it's not earned income though.
Doesn't matter. It's still income. It's unearned income, kind of like dividends or interest.
Found money as dividends or interest?
Well, I'm not really sure how that would be taxed, but it would definitely
be. But they'd figure out a way to tax it.
It would be taxed. I mean, it's not that often people find money and declare it on their tax return.
Exactly. So I don't have, as a CFP, I don't have any say other than do the right thing, whatever that right thing may be to you. But, for me, I don't know. If I had said, hey, God, I need $15,000 or $1,000 to do X, Y, and Z, and a truck opened up and blew money at me, I'd probably give it back, but I'm a wuss. I hate the thought of going to jail, and I don't know if you can go to jail for that.
What I like to see are the people stopping their cars actually getting out and picking up that money.
Oh no, they have footage of it. So what I'm afraid of though is I'm pretty sure they'll be able to see license plate numbers because somebody was filming it.
Yep.
So that kind of causes me to pause. So, be smart. Go, if you're former Catholic or Catholic, go confess to your priest. That's what I say. Go ask your priest for guidance. Ask God for guidance. Ask the universe for guidance, and figure out what you need to do. But I know, hey, like I said, if it was me, I don't know. I think I'd be in Dunwoody's police department just begrudgingly turning over some money.
And I'd be very curious on whether we get a follow-up to this story.
Ooh. Stay tuned.
Yeah,
Stay
exactly.
tuned.
Yep.
Stay tuned.
Yep.
All right, let's roll into, there's you and I have gotten into conversations. We're not going to get political because I'm always right and he's always wrong. Rob is a huge, should I say huge Yang fan? You believe in some of the stuff? Okay.
I do. Yes, I am.
So this story is really going to be right up his alley, and it has to do with AI. Is a robot? Yes, it is considered artificial intelligence,
yes,
because they learn. So a few women, and I'll find their names, Andrea Tomaz and Vivian Chu, from Diligent Robots. They built a robot called Moxie, and it goes around in hospitals, because right now hospitals are they're lacking nurses, right? Nurses is one of the few industries that we have right now where it's still incompetent. They can't fit the demand as fast as they need, right? So they've created this robot to do all of, or a lot of the things that don't involve human interaction between nurses and things that have to get done. So for instance, after a patient checks out, there needs to be new bedding and new stuff brought into the room, and this robot is starting to do it. And so in the beginning, there were some nurses who were, didn't like the idea. They didn't like the idea of a robot coming around and doing certain things. That was on day one. By the second week, they were in love with the robot. Okay, because they didn't have to, there were certain things that they didn't have to think about anymore, and they got to spend more time with their patients. And if you've ever been in a hospital, you know that you really want more interaction with nurses, because it's pretty lonely, especially if your family's not there. And I don't know if you've ever been laid up in a hospital, but it's like, it sucks. It sucks. It completely sucks. So having the nurses be able to kind of pay more attention to you, take more time to speak to you, ask you how you're doing, talk to you about your family, is a great idea. So this Moxie is hooked up into the hospital's electric health record system. So they kind of know what patients need, don't need, etc. So now this Moxie robot is a celebrity in the hospital.
Yep.
And people are actually taking selfies with the robot. And now the robot, when it doesn't have anything to do, just rolls around on the floor with little heart eyes to tell people that it loves. And so it's this interaction. The patients love it, the nurses love it, the doctors are loving it, and just ordinary people that are there absolutely love it. But I see this as the future. I know that in some old age homes now, they are giving Alzheimer patients kind of robotic babies to care for. Right? So it's like AI it is a part of our life, whether we want it to be or not. It is a part of our lives.
And that is what one of the big concerns is with AI, is that it will be eliminating a lot of jobs, probably reintroducing people into new types of work. But in the second wave of AI, it's going to be moving from more blue collar to white collar positions, as we're seeing. And to touch on that nurse factor, there's a lot of AI right now that can read medical x-rays and images at the doctor, 30 to 40 times, I believe, better than a doctor with many, many years experience.
Yes.
So we are going to see a big fundamental shift on where AI hits next, especially as it relates to the accounting.
In every field, check out this statistic. So researchers project that robots will take 800 million global jobs by the year 2030. So for, one of the things I like to tell my listeners is to really pay attention to what's going on in this industry with robots or AI. And I'm pretty sure we're not going to be calling them robots after a while, because it's almost going to be, racially, it's not PC. Term. It's not PC, so they don't like to be called robots anymore. So, but at some point, you have to look at what's happening with the economy, with careers, just basically with our economy. Is your job, is your career still going to be viable 10 to 15 years from now? And if it's not, what directions or what changes do you need to make sure you're still employable? And we even had a segment on what's that thing called, universal income.
Yes.
Right.
Yep.
I know you know all about that.
I do.
What are your thoughts on it?
It sounds outlandish, but I am very concerned about the rapid technology change. That I do think we will have a bunch of people that will get retrained at the different fields.
Yeah.
We always have.
Yeah.
But I'm concerned about how fast this change will hit, and how feasible it is for some people.
Yeah, I think
like a 50-year-old truck driver or a 50-year-old person, they may not be as easily trained as others.
well, yeah, but it's also a willingness to learn something different.
Correct.
Because there was a situation with the people in kind of the coal mining industry where they were being offered courses to retrain in other things, and they didn't want to because they wanted to wait for coal to come back. I did a story last week on climate change and what it's going to cost, I think, about $69 trillion by the end of this century. And one of the things that it was hitting on were the jobs that were going to be eliminated because of it. So there's a lot of things that we need to think about when it comes to being retrained, retooled. We have to take advantage of anything that the government is offering when it comes to being retrained.
That's correct.
Absolutely.
And
insurance companies aren't going to be offering insurance policies. Chubb, for one, won't be offering insurance policies to companies where the majority of what they do, the revenues come from coal mining, and then up to if it's more than 30%, they're also not going to be issuing any policies if the revenue from that company, if 30% or more comes from the coal industry. So for the people that are, in those mountainous areas that are waiting for the coal mining to come back, it's a wrap.
That's right.
That ship has sailed. It's not viable, as a matter of fact.
And for the younger people, they probably will have opportunities to move to different states to try to do something different. But it gets much harder as you're older and established with a family, where people just simply aren't going to leave.
But I think that's what, when I was talking about the conservative thinking, from a conservative, socially conservative standpoint, we have to learn to be flexible. That's one
correct.
of the things that in America, we've had the luxury of being able to live somewhere and just stay there for the rest of our lives. But we're going to have to really start thinking about that now.
That's right. And, and it ties into what I do for a living. I mean, with the big tax law changes, especially with the change in the code right now about limiting local taxes to $10,000, there has been big chat about people from New York, like where we're from,
New Jersey,
and the higher states moving to southern locales.
Higher states?
Yeah, like Tennessee and Florida. And I do think we're seeing some of that movement right now. But at the end of the day, for family and for other reasons, we're going to still see a lot of people stay put because there's other things besides taxes and income that are important to them.
Yeah, there are. And I think, for me, I think as a family unit, you should look at, we're going to have to rethink how we've been thinking about where our homestead is. And the reason why I say that is, we're going back to one of the stories I'm going to do on my top 5 news stories has to do with the level of wealth of our generation compared to, say, 40 years ago. Okay. And so now we're seeing 3 generations living in homes. Okay. So, they consider us the sandwich generation. Rob is like 60.
Thought I looked good.
So for our generation, we're like you got a kid that's about to go off to school, and you want to make sure you're going to be paying for that. There's some, and then you've got parents, right? And so for some of us, we may actually have to provide care for our parents. So they're calling that the sandwich generation. And one of the things I was thinking as I was going through these stories is, man, they're trying to act like this sandwich generation thing is a new thing, but it's not. That's the way things were, in the 60s, like the grandparents lived with the parents. That's not an odd thing. It's just we're going back to that. And now for parents, our parents' age, they're going to have to think about where they're going to end up. Like, it's not enough to say, well, I want to stay in my house if you can't afford to stay in your house. They're going to have to be flexible-minded to move where their kids are moving because of the economy and things like that. So all of us as a country, we're going to have to become a little bit more progressive in how we think. Fortunately, people can work from anywhere, but I think, staying in that town that you were in because that's the town that you've been in and that's where all your friends are. But if your kids have to provide help for you, I think that's being a little selfish. Yep.
And it also ties into residency issues as it relates to state income tax.
Oh, always back to the taxes.
People love to talk about the IRS, but I can tell you the states are really tightening up their audits on where is your resident. And that's very, voluminous for this radio show, but that's going to be the next wave of audits, the tax audits related to residency.
Where do you really live? Well, I've got a home in a state where I don't pay state taxes, and I spend 6 months and 1 day there.
And I have a driver's license here, but I have a side gig there. So
Yeah, that's
interesting to see how it plays out.
All right. Well, we'll be back in 2 minutes with Rob Tamburri. We're going to be talking about the tax law, what they had promised us, and where we are today, and how you can benefit from it when we come back on Financial Renaissance with the M's. And we're back with Financial Renaissance with the M's. I'm sitting here with one of the dopest CPAs, one of the people that I can always call when I have a tax question or I'm pissed off about something with the tax code. There's a guy that I call to make sure that what I'm thinking is right and that I'm justifiably upset, and I'm usually justifiably upset. Rob, why don't you tell everyone about your firm and how long you've been in the industry, all that good stuff.
Well, I've been gainfully unemployed since 2010. In 2010, I put out my own shingle and started the Atlanta office of Balog and Tamburri. We do tax work, virtual CFO work, due diligence work. We have offices in Jacksonville, Florida, Cross City, Florida, and St. Augustine. I've been a CPA for almost 30 years and started out at one of the big 6, which is now the big 4, alumni of Deloitte & Touche in New York. And been very interested in this tax law change.
Have you been?
I have.
All right. So what does being a part-time CFO entail? Like, do you go out, is that, like, so I've learned a new term called fractional consulting, I believe?
Yes.
Is that what?
Yeah, when we opened the practice, it was a real big push to do outsourcing. Businesses were outsourcing HR, finance, accounting, and I had come from an environment where I pretty much ran the financial back office of a small family business. They did about 10, 11 million in revenue, if my memory is right. And I put 2 and 2 together and said that most people who have, quote, real businesses aren't always the most financial savvy. Okay? A lot of these businesses, as a stereotype, tend to be founded by expert technicians or great salespeople. And they either sell their way out of a problem or kind of just hold on, and then something hits where they have lost the ability to manage the financial operations of those companies. So what we do is we provide controller, CFO level type work to the business owner. And it involves either the total back office, where we take over the bookkeeping and accounting and work with our own accounting people to pay bills, etc. Or we meet the owner kind of as a board of directors, where we review the numbers, talk about the key issues of the quarter, maybe help them get access to some type of funding. But we take over that role, and our goal there is to improve the client's financial condition. So a lot of times is really watching cash flow and improving margins.
So is there ever a situation where, you see business owners that are doing really, really well, and then boom, hit a wall because they're doing so well?
Yes, it's very, very common. It's common for 2 reasons. The first thing is, it's the law of numbers. It's easy to meet a $5,000 payroll, okay, but much harder to meet a $50,000 payroll. As an example, if collections have slowed down, because maybe your accounts receivable clerk is overwhelmed. So now money is not coming in as fast, but yet the bills is still there.
Right.
Another great example, which is an old saying, is you want to get your line of credit when you don't need it, because when you need the line of credit, you're not going to be able to get it. And we've been telling clients very recently, we are due for a change in business cycle. Credit will tighten, so go ahead and do that now. Get that line of credit.
Say it again. We are due for a change in the business cycle.
We are due for a change in the business cycle.
I have been screaming, the recession is coming, or the downturn is coming. Which phrase do you like better?
Well, let's call it a recession. It's a natural outflow of a capitalistic society. We've gone through many recessions in this country, and this has been the longest expansion in history. In history.
After March of every day is the longest. It becomes the longest, a new record.
So I can tell you, I was one of the few kids that paid attention to statistics in college, and I understand reversion to the mean quite well, and I understand the bell curve and things like that. And we are going to regress back to the norm. It may be 18 months from now, but it's coming.
And one of the factors, one of the things that I try to explain to people is we could be in a recession very well right now. Economists will not call it for another year, possibly, until they have all the data. But me, from a financial planner standpoint, looking at the data, I see all the signs and symptoms that we're butting up right up against. And again, when I say crash, I don't mean like the 30% crash like we had during the Great Recession.
No, it could be a normal
but it could be a
pull-down.
normal pull down, which is about 10%. I think that's also an area for opportunity for people.
It is, and Emma, I want to jump in here for a second because although I'm an accountant by trade, I was a minor in psychology in college, and I do believe psychology ties into business way more than just, high level.
Okay.
My point here is once people begin to feel that there's a possibility of a recession, they start making some quick decisions. Maybe we should scale back a little bit. Maybe we shouldn't hire. And then they tell their friend at the golf course or at dinner, you know what, we're not going to hire next year. And it's a ripple effect, even if it's not true yet.
Yeah.
It begins to build upon itself. And then what's happened? We've talked the country into a recession.
And that's what happened. And again, with the last Great Recession, granted, there were certain things, mitigating factors that should have led to, we were all waiting for a correction. Because even myself in my practice in 2007, July, we started taking stuff off the table for people that we knew were going to be retiring within 5 years. We started making changes because we're like, we hit an all-time high at the time. It was 14,000.
That's correct.
It was 14,000. And we're like, oh, let's go ahead and start pulling back. The market's due for a correction about 10%. But what we didn't know is, we also had social media at that time. Mm-hmm. So things ran like wildfire. The television stations, sensationalized financial journalism.
Correct.
Ran like crazy. The people on TV were telling people, if I were you, I wouldn't be in the markets right now. I would pull back and I would be in cash. And it caused a mad dive down to the bottom.
Well, it goes back to psychology, right? Because in investment management and business world, the words you don't want to ever hear is this time it's different. But boy, during that time, 10 years ago, which I remember well, it really felt like it was different.
Oh, it was different because it was from myself being a financial planner, we're taught asset allocation, right? That if you have everything in the right buckets, but this was the 1% time where asset allocation didn't matter. If you were in the markets, whether it was the bond markets, the equity markets, anywhere you were, you got hammered.
There was no place.
There was no place to hide. There was one place to hide, but I won't let that out. I'm gonna let that cat out the bag. There was a place to hide. But fundamentally, yes, there was no place to hide. So these are some of the things that we want you to think about. Again, if we're going into a recession, some of the things that you should be focusing on are saving your cash, making sure that you're ready for opportunities, because anytime the market goes down, there's going to be an opportunity to buy. Warren Buffett says, when people are running to stuff, you should run away from it. And when people are running away from stuff, you should be running too.
And that's worth repeating. And that's advice I'm going to hopefully take advantage of myself. The buying opportunities, whether it's real estate, the market, are when the economy goes south. And people love to say, only if I had the cash to get in now, because they were smart enough to be aware that it was a good opportunity. But cash gets tight.
Yeah.
Cash is hard to have.
Once you find out we're in a recession, you're not going to be able to get the lending. So to your point, if you're a business owner, this is the time to start creating relationships with business bankers. I've actually done that myself. I found a business banker that I like, and I don't care what company Michael Daniels goes to, I am following. Okay, because for me now, it is about the banker and not the bank.
And start paying down your debt. One of my favorite lines is, leverage is your best friend during the boom, and it's your biggest enemy during the crisis.
Exactly.
Because it comes up and you got to pay the bill every month.
I love how you just reiterate everything I said. It just makes me look even better. Right. We're half back.
I'll go back.
Back. So there's a song by, and I don't have it with me, by Jay-Z and this guy named Pusha T. And the lyric is basically, my accountant, who should win the Medal of Freedom is my accountant. Because he's been hooping around loopholes. My townhouse should be surrounded, but basically because of his accountant, he's able to get, do a whole bunch of stuff. And one of the things I want people to understand is that term loophole sounds like a negative. right? And I don't think that that's a negative. If there's a law and you follow the letter of the law, is that negative? Is that considered a loophole?
It's a legal loophole, absolutely.
But all right, just gonna argue about the loophole, but we won't even go on that. We're gonna stay focused and stay on script. One of the things that I wanted to revisit, and what we're gonna revisit today, a lot of people have done their filed their 2018 tax returns. And, I want to look at what the government promised us in 2016, 2017, when they first discussed the tax policy changes. And so we're going to talk about what came out. So the Ways and Means Committee said, hey, there's going to be top 10 wins for the American people with this new tax law change. So there was going to be more jobs. Came out with a tax reform blueprint, and they said, okay, primary goal of this blueprint is to create a tax code that grows our economy, encourages job creation, and raises take-home pay. So I'm gonna ask, since you've done a whole bunch of 2018 tax, and I know you're not done, have you seen a raise in people's take-home pay? And not counting the changes in the withholdings, because I know there was a big issue.
Let me just touch on that quickly. Like anything in life, you have to beware of the sound bites that we'll be hearing on the news. During the initial tax season a few months ago, there was that big wave of conversation that people are paying more. Okay, but again, as you just said, Emma, correctly, in a lot of those circumstances, the taxpayer did receive a lot more of that money during the year from less withholding.
Correct. So when they saw their tax return and didn't see the big refund that they were used to seeing, it was because you got that back during the course of the year, which is ideally the best way.
Correct.
That's ideally the best way.
And you'd be surprised if people don't notice those changes in their paycheck.
Yeah. So the second thing was supposed to be more opportunities. By growing jobs and businesses, the blueprint will create more opportunities for all Americans, but especially those stuck on welfare or in need of more and better work.
Well, I can tell you this, okay? One of the reasons why I do think we're ready for some type of cool down is whether you believe the unemployment numbers or not, I can tell you from what I see at my desk, the economy is red hot.
Yeah.
The employment on the lower level, meaning your entry level and blue collar type skill sets, our clients can't find qualified people. When they find qualified people, they have all the power. They'll jump ship for $1 an hour or more. Some types of businesses can't find any people at all. People talk about the minimum wage and what it should be. From my business brain and my business side, the minimum wage becomes what it should be. And I can tell you, in the greater Atlanta area, we are very close to a de facto minimum wage of $15 an hour. People are getting paid 11, 12, quitting jobs, asking for another dollar. They come for a couple of days, then quit and go to another job. So things are very strong. So in that regard, whether it's just related to the tax code or not, we are fully employed, even if everybody's not in the position they necessarily want to be.
Correct. So we're fully employed, but there are a lot of people who are underemployed. And that is the statistic that we don't have the data to back that up.
That's correct.
And I feel like it's a hidden number. I think somebody has that number. Give us that number. But the proof is in the pudding, as they say.
Yes.
And as I mentioned, we can tell that because wages have been stagnant for the last 40 years, and the net worth of the bottom 90% of our society has dropped in the last 40 years, has dropped by 10%. So the bottom 90% used to own 40% of the net worth of the country. We're now only own 30%.
That's correct.
And the bottom 50 only owns 1.3%.
Because the jobs and the wealth are going to what we call the winners of the economy. Highly educated, those with the very, very technical skills. And again, the change of technology has kept a downward pressure on wages because we didn't need the people, we had the machines. Although I will say that's changed of late, especially the last 6 months.
Yeah. Why are you saying this changed?
Because the pressure mounts on the rising wages. We are seeing the rising wages now because there's just that much demand for those jobs where, between technology and the people, it's finally showing up in the payroll numbers.
Well, one of the big factors of the tax code change, they said it was going to be more simplicity. They said we were going to be able to file our tax return on a postcard. So now the new 1040, page one of the 1040, is pretty small. It's like half a page.
It is.
But is that more do you feel overall when you went to do taxes with the returns this year, do you feel it became simpler? About the same? Hard, more difficult?
Not at all. The only real simplification came that we saw a lot more clients using the standard deduction. Okay. With that being said, a lot of people have complexity to their return. They own businesses, they have rental property, so that really didn't change too much. But what it did do is it did simplify tax preparation for your regular worker with a W-2 who may or may not own a home. Other changes along that, there was almost a doubling of the standard deduction, which now has helped fewer people itemize. But shell game sounds negative, so let's just say exemptions went away and people didn't always understand how exemptions work. Rates came down, which is a good thing. That standard deduction doubled. And for those who itemized, miscellaneous deductions have been completely eliminated. And the most important thing, which of course has been all over the news, is the cap on the SALT, the state and local taxes, capped at $10,000, which personally, I just don't think it's fair because you really don't have much of an impact on that unless you're going to move to a no income tax state.
Yeah, or a lower income tax state. So for what
and
you
again,
what you call the people who?
High income or
No, you call where they live high states.
The high states.
High
Yeah,
states.
the high states.
That's a new term for the East Coast, high states, Northeast. So let's take a wild ride on the tax slide. Let's talk about, you brought up home ownership.
Yep.
And you and I had this conversation. Rob and I share, quite a few clients. And one of the things that, I've been looking at now, is the home buying stats. And a lot of young people aren't buying homes right now for obvious reasons, income, college debt, etc. But does it make sense, in your opinion, for people to buy homes anymore?
Well, people have always taken, blanket thoughts and policies from the past and say, well, there's a lot of tax advantages to buying a home, okay? But they don't always understand what that means. Long story short, up until the tax code change, all your property taxes and all your mortgage interest was deductible up to about $1 million in primary debt. So the cost of that, those interest and that, those property taxes did help offset the overall tax bill and made buying a home cheaper, all things being equal. I mean, let's not talk about maintenance and all that, but it was definitely an extra financial, what I would call accelerator or incentive to do that, okay? Under the new code, with the standard deduction, those are capped out at $10,000, meaning candidly, for a married taxpayer, you would have to have a lot larger of a mortgage to have the ability to itemize. Okay, so what's happening is a lot of people aren't itemizing, so you're going to get that same standard deduction whether you rent or whether you buy.
Right.
Okay.
And so for me, when I think about whether or not it makes sense to buy a home, if you're doing it just to have a place to live, then this is a conversation with your CPA. But for me, I will always think of buying a home as kind of a jump start for a lot of people to wealth building.
That's correct.
So when you're trying to make a decision, or if you're listening to the naysayers or Debbie Downers or Donald Downers about home ownership, I look at it the same way I look at college education. There's a lot of talk right now about college education. College isn't for everyone. College isn't necessary. College is overpriced. However, in about what year is it? Let's say in the next 10 years, 65% of the jobs that are going to be available in our country are going to require a college degree. Okay. Most people that go to college don't necessarily use their degree. If you graduated, mine was in IT, I'm doing financial stuff now. Most people don't do the same thing, but they graduated, but it is very important. Home ownership location.
That's right.
Where you buy matters. Even Jay-Z said, he could have bought a piece of property in Dumbo for $2 million. 6 years later, it was $8 million. Now it's like 20 something million. So you should always look at property. I did an interview with Chubb Rock months ago, and he said, hey, re-gentrify your own neighborhood. What's the hood now won't be the hood 10 years from now.
That's right. And your life changes. So in addition to being a holder of wealth, which of course is has something to do with your annual tax bill when you file your return, as your life changes, if you are in location, one, chances are you will see appreciation on that property, okay? And the tax laws are very beneficial to that, which I'll touch on. And more importantly, it also gives you the ability to rent out that home and get income. And the new tax code has actually given us another benefit on that. So just to talk about sale of primary rental.
Let's talk about the rentals, because we've got viewers that have rental properties and things like that. So how is this tax code beneficial for people that may have rental properties?
Okay. The big takeaway on the tax code changes is that they are all very business friendly. Okay, and that doesn't necessarily mean Apple Computer and the big boys. It also means people with much smaller companies. A lot of the legalese gives the same rate of benefit to small and large companies. So it is equal opportunity in that regard. Okay, owning a rental property. Okay, and besides the fact you have a tenant building equity for you, okay. Also, if your income is below $100,000 per year, okay, any losses generated from that property become fully deductible against your W-2 wage income. Okay, it phases out at 150, but and I should say, without going into the weeds, you never really lose those losses. They kind of just hang out until the property is sold. Okay. In addition to that, there's a new area in the code called Section 199. Okay, which will give, without getting into all the specifics, additional tax relief on that income to that taxpayer. So in addition to potentially deducting the losses, let's just say you will pay taxes on less of the income as you did in your tax.
Oh, nice. That's okay. Now I want to clarify something, because as I'm going through the new, looking at my clients' tax returns as they come back, and I'm trying to figure out tax strategies now for them. Looking more at 2020 and 2021. Forward thinking. What are some things that we need to change? When you said, the $100,000. One of the things that's missing really for me on the front page of that 1040 is the AGI number. That used to always be the number, that boom. So now we're talking gross income and now not adjusted gross income when we're talking about these numbers?
No, we're talking about AGI, and that and it's still there. I don't remember the line off the top of my head.
It's on the second page.
Yeah, I mean, that line is very, very important.
Okay.
But if I could go back to touching on still, which to me is one of the most generous items in the tax code. It was up to be changed, but they did not change it toward the end of passage, is the relief of gain on your sale of your primary residence.
Oh, that's still there, right?
That is still there.
That was going to be anarchy.
Well, no, they were going to really change the timeline, because they were concerned about flipping. But where we are today, if your primary home is still your home for 2 of the previous 5 years, okay, and that's a black and white test. All right. The first $250,000 of gain is tax-free to a single person, and the first $500,000 gain is tax-free to a married couple. That's the good news. The bad news is if you happen to lose, that loss on your primary residence is nothing.
It's just a loss, and that's always been the law. That's always been the law. So that's not anything new, but it's something that people need to take into consideration. You cannot deduct a loss on your primary property if. The flip side of that coin is, had you made gains on it, you would have walked away with that money tax-free. Correct. So you can't have it both ways.
Now, if I could also add, clients at rental property, they did make changes to what they call the like-kind exchange law, Section 1031. Yeah. All right, and that's very important for people who have real estate. That's a business. Okay. Long story short, the definition of like kind was very loosey-goosey. You could swap out real estate for collectibles and things along those lines. Now it's pretty much real estate to real estate. And what that does is it just kicks the can down until you finally liquidate property at some point that's not in that like-kind exchange. So you keep on deferring those taxes and passing it down.
Yeah. What about, so let me tell you about it. Thank you for that, because that was a big one. Everybody wanted to know about the home ownership question. And for me, it's never a thing where, if you're in an area where there's not going to be appreciation, go ahead and rent. But if you are looking in an area where there's going to be appreciation, good schools, things like that, it's more than just the tax code. There's also wealth that will be generated from that. Now, I had a horrific conversation a couple of weeks ago with an HR person about retirement accounts.
Okay.
And, I realized that, we were talking earlier about stay in your lane, right?
Yep.
Stay in your lane, right? And I'm realizing that there's a bunch of HR people out there that are giving retirement account advice and tax advice. And they are absolutely clueless. So let me tell you how this conversation went. I talked to this, so for one of my clients, I was trying to figure out whether or not they had access to a Roth 401k. And I was trying to figure out, based on their tax returns, do they need to be putting all their money away on the pre-tax side? Okay. If they don't need the tax deduction, then we may want to look at the Roth side, or we may want to look at a non-retirement account. They call it qualified or non-qualified, or a regular brokerage account, because you pay capital gains taxes in those accounts versus ordinary income. So call the lady, talking to her, and first thing she says to me is, this person isn't maxing out their 401k. And I was thinking, this person doesn't need to be maxing out their 401k. They're just trying to get up to the match, right? Yeah. All right. So that was strike one. Then, we're talking, and then, I say to them, well, we're trying to figure out where to put the monies because, we're worried about taxes. Then the HR person says, well, they don't have to take their money out of their 401k when they retire. They can leave it there till they're 70 and a half. And then at 70 and a half, when they start pulling the money out, they should be in a lower tax bracket by then.
Not always.
You weren't on this call with me, so you can imagine. So let's talk about the taxation of retirement accounts, right? So this conversation was bound to go left so fast with me, because I was thinking, oh my gosh, what are you talking about? Why are you talking about this? And why do you have these thoughts? Like, those are some rules, but those rules don't apply to every one of your employees' situations.
Correct.
Because some employees have more than just the income that they're getting from their W-2 job. Some employees have other things going on in their lives, and so you're not, as an HR person, not privy to that. So let's dig into the taxation of retirement accounts.
Okay.
All right.
First thing I like to say about retirement accounts is it's very critical that you work with your financial planner and understand the pros and the cons of what you're doing. And understand this is a plan, okay? It's not exactly how that outcome is going to be, so you have to make the best decision at that time. The audience needs to know the IRS does not want you to take money out of retirement accounts until you are 59 and a half. Okay.
And they made it very clearly, because
if you do so, there is a 10% penalty off the top of what you remove before we're calculating what your tax bill is on that. So what happens is 6 or 7 times out of 10, client withholds maybe the 10%, maybe the custodian is requiring that, and they never give thought to the fact that that retirement withdrawal is now being added to their other income, and a good chance pushing them now into even a higher marginal tax rate.
So let's break this down for Main Street. Because you and I like to talk Wall Street in Washington. We know this stuff like the back of our hand. We eat, sleep, and drink it, but not everybody does. So let's say, for instance, you need to take $10,000 out of your 401k, 403b for whatever reason, not to buy a home, not for medical, because there's certain stipulations, there's certain exceptions where you can take money out and not be subjected to a penalty.
And to let you know, you need to let your custodian know you're withdrawing it for an exception, because we see multiple tax documents at tax time, Emma, coded wrong, and clients are telling us, well, we use this for A or B, and I'm like, I'm sorry, the document doesn't show that, and you're going to have to get it reissued.
And it causes like of course you know for you those what is it, February, March, April. Or just I don't even get a chance to talk to him. I get a few messages here and there. But so if you're taking, let's say, $10,000 out,
Yes.
So off the rip, 10% is gone to the government because that's your penalty. Okay, how much money is that?
That's $1,000.
Okay, so now you have $9,000.
That's right.
Now you're going to pay taxes on that $9,000, but you're paying ordinary income taxes.
That's correct.
Okay, so let's just say we're looking at 10%, or let's just say
24%.
Yeah, federal and state.
Plus 6% for the state. They're looking at 30% of the total amount,
Which is 10.
which is 10. So that's 3,000
Plus the 1,000.
plus the 4,000. So in this rough example, you're losing 40% of that.
Correct. So
Yep.
you needed 10,000. You take 10,000 out, but what you have to put in your hands is going to be about 6,000. But you may still owe additional taxes. What was taken out for federal and state wasn't enough because your income, by you taking that 10,000 out, it can bump your income into another tax bracket, and that's the thing that people don't think about. Okay, when it comes to playing around with your 401ks, which is why you should have money in savings. Your 401k and your retirement money is not for savings.
That's right. And it can have ramifications with other things, financial aid.
Oh yeah.
I mean,
oh my gosh,
you have to think it through on what you're trying to do.
Correct. So that's the pre-tax. And some of the pre-tax types of accounts that we have are going to be your 401k, a 403b. We even consider your pension pre-tax, not because in some instances you're not putting money in there, your company is, but pre-tax accounts, when you go to touch that money once you've retired, you will pay ordinary income taxes on that money.
That's right.
Okay, and your tax bracket may not always be lower. And quite frankly, we don't know where the tax code is going to be.
That's very, very true.
We're in the lowest tax rates. I did a story. I was talking about the American Revolution last weekend and the economics behind the revolution. And once you give people a low tax rate, or people are used to not paying taxes, once you try to ratchet that higher, we just freak out.
You do.
Whether it's justified or not, we just freak out. You can't take stuff back from us. That's
correct. And you have to do an analysis on what your situation is going to be. You hear in the media all the time, tax rates used to be 60, 70%, 50, 60 years ago, and all rate is so low. Well, candidly, that's like paying the rack rate at a hotel. Right. Okay, so much more was deductible. The rack rate, in other words, you ever see the rate on the hotel? It's like $900 a night. No one ever pays that rate. Yeah. You get a discounted rate. Years ago, we had a lot of different things that were deductible. Who remembers that credit card interest used to be deductible?
That was like in the 80s, dude. That was also your car, because that's why I didn't get a car at 16, because they couldn't deduct it. That was like awful.
So the rate is advertised, maybe it could have been 70, 80%, but you had a whole bunch of deductions, which were long but unlimited. Yeah. So what is your net effect overall?
Yeah, and that's one of the things that we don't have a crystal ball, so we can't tell that. So when we're looking at, or when I'm looking at people's retirement, I'm thinking about where we are right now in the tax code, and based on the tax laws, what you're going to be pulling out. If you're pulling out 40, 50,000, well, you're not in that lowest tax bracket.
That's right.
Unfortunately, right?
That's right.
So is there anything else in that pre-tax bucket that I didn't mention? IRAs, traditional IRAs are in there.
Yep, traditional IRAs are in there. 401ks are in there. SEP, simple accounts, depending if you're a business owner. Again, without going into the detail, there's a lot more opportunity to defer income for retirement if you're a business owner.
Mm-hmm. Especially up and above the 401k, right? There's so many,
That's correct.
The window opens up. You can deduct, I think, up to about 100, depending on your age and income, about 180,000 tax deductible on top of the 401k. But that's a different conversation.
Well, that's a different conversation.
Yeah, that's a different conversation.
Things. But before it slips my mind, again, a lot of the changes in the code benefit businesses. Mm-hmm. And people need to understand, if you're part of the gig economy, which a lot of people are, and paid on a 1099, you are deemed self-employed by the IRS. And it opens up a lot more ability to deduct things that are to your benefit, including most, SEP retirement plan, being able to contribute money much more than the IRA level.
Right.
So people hear, oh, I don't want to be paid on 1099. Well, there's a lot of reasons why you don't, but depending on how you're set up and what you want to do, there's a lot of advantages to being on 1099.
Definitely. So from a tax-free standpoint, retirement account. So when we say tax-free, nothing is tax-free unless it's kind of like money that comes from a life insurance plan and you're the named beneficiary under a certain dollar amount, etc. So in our world, what we consider tax-free are accounts that you put money into with after-tax dollars. So you receive your paycheck, or if you're 1099, whatever, and you put money into an account, it's allowed to grow and you pay no taxes on that money.
And a Roth IRA would be a great example of that.
Exactly. So Roth IRA is a great example. Roth 401k also is another area for people who cannot put money into a Roth because of their income levels, right? So if you make too much money, Roth IRA is not for you. They cut you off. And there's a scale.
Yeah, and that's part of the alphabet soup. I mean, what frustrates my business partner and I is the days of the napkin test where people ask you questions, we make calculations along over. I mean, there are various thresholds for each type of thing on the return to determine where you qualify and where you don't qualify. But to the audience, the Roth level is substantially lower than the traditional IRA.
Mm-hmm. Yeah, it's kind of like we really don't want you to be able to use it. And if you're married filing separate, you can't use it. And most people don't know this, and you don't want to find out, especially if the IRS is going to be looking for ways to kind of get us.
That's right.
So you want to make sure if you are married filing separately that you're not contributing to a Roth. You're going to hose everything up. A couple of other areas in the tax-free, you look at municipal bonds, although they're not really in favor right now. I believe they're overvalued. And then also cash value life insurance for people who are way above, like from an income standpoint, you're looking for other places to kind of tuck money aside and not have to worry about the tax consequences, but you have to be able to afford it.
That's right.
So those are some of the areas in the tax-free area where you can put money into it, it's allowed to grow, and then when you pull the money out, you don't have to pay taxes on it. Now, let's talk about the regular traditional brokerage accounts.
Okay.
Non-qualified. What's another word besides, qualified means that it's tied to IRS code?
Qualified means it's retirement money. You've had previous deferred money. Basically, an IRA qualified account means it's subject to ERISA, and it's not fundamentally, it is a retirement account.
Right. It's a retirement account, and that's how the IRS is looking at it. And so a non-qualified account or a regular brokerage account is an account that doesn't have that handcuff of 59 and a half. There's no laws, like if you put money into it and you're investing and you want to take it out 5 years later, you can, and what you pay is capital gains versus ordinary income tax.
That's right.
Can you talk about the changes in the capital gains laws?
Okay. The good news is, under the current code, long-term capital gains continue to get very, very preferential treatment. It would be 15% up to about, I think it's 400 and something thousand of income.
Okay, so let's pause for a second. So if you have money in an account, if your adjusted gross income is over 400,000,
it's like 420 perhaps, some home to that or something.
Yeah, and if you have a portfolio full of stocks or mutual funds or what have you, and you started, and when you started it was at 50,000, and now it is at say 250,000. So you've got 200,000 worth of gains.
Yeah.
Okay. How much? And you sell everything. I want all my money because I'm gonna move to another country. How much do you pay in taxes, or how are you taxed on that money?
Okay, easy question. If you're above that threshold, which would be considered a high income earner, it would be 20% Uncle Sam, and then your state tax rate, which in our lovely state here in Georgia is 6%. So it would be a 26% overall tax. And again, without getting into the weeds, and this goes back to the napkin test, you are still subject to the 3.8%, what they call NIC tax, the net investment tax, which was put in under the Obama administration to help pay for the Affordable Care Act. So you're looking at about 30% there. But to most taxpayers, the regular long-term capital gain rate is 15%.
If you're under that 420?
Exactly. Okay. A lot of this. So you have 15% and then 6% for the state, gets you to 21. If you're subject to the NIC, and I can tell you this is a calculation I remember, If you're single, the NIC kicks in at 200,000, and if you're married, it kicks in at 250,000. Emma hasn't asked, but the marriage penalty still remains active even with the new code. Meaning that a lot of times, two single people will pay less tax than a married couple. Not always, it all depends, but that was not eliminated in the code, which could be a conversation for another.
See, we shouldn't have got married. I think we should have stayed single. It wouldn't have been better. All right. The tax code, that was one of our biggest issues. First time we had to file taxes together, it was a nightmare because both of us were looking at each other like,
yeah, and I would
you're
argue
costing me money.
being single also benefits the homeowner because that standard deduction is only 12.
Yeah, versus the 24.
24, so it hurts married people buying homes.
Yeah, so
from a tax perspective.
So I always, whenever I try to explain capital gains to people, I always go back to Mitt Romney and his tax returns and how everyone was just appalled that he was paying 11 or 12% in taxes when he was so wealthy. But again, the reason for that is a lot of wealthy people don't have all their money in retirement accounts, which the lower bottom 90% of our country does. The top 10%, a lot of that money will be in non-qualified accounts, and they pay capital gains versus ordinary income taxes. So that's one of the areas that we're trying to round out while we're talking to people. Now, my least favorite thing about the tax code, itemized the standard deduction.
Yes.
Because man, where do I start? Let's start with charities. First, let's talk about what the standard deduction is, what they did with that.
Okay. The whole purpose of the standard deduction over the years was the IRS's way of giving everybody a level of relief for rent, for small charity, for small levels of medical expenses, just for things they felt that would impact you from a tax perspective, okay? Most people with homes or people who were philanthropically oriented always itemized. The itemized portion for all of us over the last 30 years had always been made up of the basics, okay? Medical expenses, which people have to remember. Is it deductible? Yes, but do you qualify? Okay, and that trips people up. I tell my clients you don't want to qualify for the medical, okay? Which under the old rules, before the tax law change, and even for 2018, 7.5% of AGI, okay? Anything above that, those are medical expenses that you would be allowed to put in your itemization bucket, okay? Right now in 2019, that number is now 10%, okay? So unless you have substantial out-of-pocket medical, no one's deducting medical expenses, okay? I'll touch on something on that in a second. With property taxes, we already mentioned this at the beginning of the program, your state and local, okay, this would be any kind of ad valorem or, depending what state you're in, plus your property tax is now capped at $10,000.
So for those people, like if we're in the southern states, like that sounds like no big deal. Right. But if you're in the northern states, your property tax, if you've got a home that's say $500,000, $600,000, which is normal there, your property taxes may be about $16,000 to $17,000.
That's right.
And so out of that $16,000 and $17,000, and before the tax law changed, you used to be able to deduct that $16,000 to $17,000 that you paid to the state, dollar for dollar.
Dollar for dollar.
Now you're capped at $10,000.
That is correct. And you don't have to just be in a high tax state. Right here in Atlanta, our firm has a lot of clients in the city of Decatur, which is probably the highest taxed domain, for lack of a better word, in the Atlanta area. And these people have definitely taken an impact when you have city of Decatur, city of Atlanta, blah, blah, blah.
DeKalb County.
DeKalb County.
Yeah.
It adds up. So anyway, that's been capped at 10,000, and there's been a lot of things on the news on that. Going down the list is mortgage interest, okay? Mortgage interest is still deductible. If you had a home before, I think, December of 2017, you got a full interest deduction up to, I think it was about million one of what they call qualified mortgage debt, okay? And that is still in place. If you have purchased a home in basically 2018 forward, that has now been reduced to $750,000. So So if you keep your mortgage below 750, still fully deductible. Okay. There's been a big change in the home equity loan situation. Okay. Before the tax law change, if your debt was against your primary residence, you could take a vacation with it, you could buy a boat, and you got the deduction. Okay. Not anymore. There was some turmoil about what the new code actually was allowing you to do, but the IRS did clarify it at the beginning of tax season. It has to be to improving your home or making renovations to your home. So if you go
primary residence.
Right, to your primary residence. So if you want to go in and, add a dormer or put in hardwood floors or make some kind of improvement, that dormer, it's the old Northeast term, knocking out the Cape Cod attic and, putting in something bigger, that's fully deductible. But if you take the loan, it's not like you can't take the loan, but if you use the home equity loan for personal use, and
not the property.
Right, and keep in mind, you can't borrow on the home equity loan now to buy a second home. That is not considered an improvement to your primary property, okay?
Now let's talk, go ahead.
Charity, let's get to charity.
That's
charity is one of the big improvements, okay, in the code. Now, I don't know if that's because Trump's a Republican or what, but typically your charity was always relatively maxed out to 50% of your AGI in a given year. They've upped that. It's now 60%. Okay. If you donate stock, it's only 30% of your AGI.
Okay.
Okay. A couple of things I want to say on this area. Now that it's gotten a lot tighter to itemize, my partner Rick and I are very concerned you're going to see increased abuse in that area, coming up with, extra goodwill, maybe claiming a little extra money. This is a high area for audit. Okay, it's always been, and we expect it to get worse. One advantage that I think you should tell your clients, Emma, is a great way to get the charitable deduction is to donate appreciated stock from their brokerage account. Okay, you don't get the deduction, but you don't pay taxes on the gain of those securities. So it helps you give more money on a tax-effective basis because you're not paying taxes, and it gets it out of your portfolio. And I think the charity wins, and I think the taxpayer wins in that regard.
But 50% of our country, 50% of the people in our country do not own taxes out or do not own stock outside of their 401ks.
Correct.
Right.
Correct.
So depending on what your net worth level is, this makes sense.
That's correct.
Depending on what your net worth level is, this makes absolutely no sense whatsoever. So
that is correct.
So that's advice for the top 50% that do own non-qualified stock.
Yep.
That's a way to get it to a charity. Now, what about the other people that, where they used to stroke checks and donate outright to different charities?
You can still do that. My advice to you there is give it some thought. There is a term in the CPA world called bunching, meaning that based on what you're doing, you may not qualify to itemize 1 year, but perhaps if you bunch, say, your medical expenses, okay, like LASIK and things like that, along with charity, you might be able to then itemize in 1 given year.
So for instance, let's say, and does this have to do with the standard deduction?
It does.
Okay, so as a single person, the standard deduction is $12,000.
That's correct.
Okay, and let's say you were going to give $6,000 to a charity 1 year. Well, you giving that $6,000 to the charity is not going to matter if your standard deduction is $12,000.
If that's all you qualify for, yeah. So if you have to look, do you own a home? Do you have any out of pocket? You'd have to do that calculation. So perhaps if you gift around the holidays, you may say, you know what, I know my situation may be different next year. I'm going to donate that now in January of the following year.
And so if you donate $12,000, right? So if you don't do it in the current year, but you do it in January of the next year, and then you make another contribution that year. That's what you mean by bunching.
That's
just trying to get
be smart about what you're doing and how you're giving your money, or aligning your medical expenses, if that would be the case.
So what is your opinion, if any, on donor advised funds? Because that's one of the things that we're doing at our firm now is giving people the opportunity to get the deduction and then figuring out later on where they want those monies to go.
I highly recommend that. The advantage of the donor advised fund is you're making a one-sized initial contribution to that fund. You're getting the deduction the year you make that contribution. You're not getting the deduction when it's dispersed. Right. Okay. So again, it could be a situation where you really want to give the money next year, but you got the money now to put in the donor advised fund. So put the money in now, and then cut the check to your charity of choice the following year.
And you can change the charity of choice.
Absolutely.
Like just because you put the money in this year, you can now, like let's say you put 20,000 in, you can decide, okay, I want 5,000 to go to this charity, 5,000 to go to this charity. You know what? The other 10,000 or whatever that's left, when I pass away, my kids can decide what has to happen with that.
That's correct.
And you can make that kind of a legacy thing. So there's a lot of flexibility with donor advised funds. Mm-hmm. What are your thoughts on charitable remainder trusts in relations to giving money away to charity?
You definitely want to speak with your financial advisor on the pros and cons of that, but the advantage is when you put money into a CRT, you're getting high levels of charitable deduction the year you do it, and you're getting to enjoy the income stream of that investment during your life. Right. So again, it's not for everybody, and a lot of times it's not even for the middle class. Yeah. But if you have the means to do that, and you are again philanthropically inclined, everybody wins.
Yep.
Do want to say, because you talked about the people on the lower income spectrum, mm-hmm. the doubling of the standard deduction, has given a lot of relief to taxpayers. So if you think about, well, I can't deduct my $100 check here or $300 check here, remember the fact that the standard deduction is effectively doubled, that's been baked into you. Yeah. You're getting the benefit of that. Yeah.
Let's switch gears and talk about the tax code in regards to the children.
Okay.
The children tax credits, things of that nature. Let's talk about how it used to be and then where we are today.
Okay. The government /IRS,
Department of Treasury.
The
Department of Treasury makes the rules.
But remember, there's a lot of social code. It's always been in the tax law. Okay, we like children. Children become future taxpayers.
Who likes children?
The government, the Department of Treasury, because they're going to be future taxpayers. So they are encouraging people to have children. Now, you can decide whether you think the benefit is strong or not. But I can tell you, in the latest round of tax changes, it has gotten more generous. First and foremost, with the elimination of the exemptions, they have passed a child tax credit of $2,000 per child under 17. That means 16 and under. That's tax speak on how they write the code. That's a very advantageous credit. For those in the audience who may not always understand, a credit is not a deduction. A credit is a dollar for dollar relief of your bill. Okay?
So each kid is $2,000.
Each kid is worth $2,000. So
is that based on your income though?
It is based on your income. I forget where the phase out is, but it's much higher. Okay. Most families qualify for it.
So if I make $100,000 and I have two kids, I get $4,000.
You're getting $4,000. So they expanded the amount of the credit, and they expanded the phase out, what I would call most lower upper middle class families.
So I know, I used to always tell my son he's not giving me any benefit, because I think it was like $1,000. Like if your income was over a certain amount, I think you got $1,000 previously. Or something. If you got it, exactly. if you got it. So to me, I'd be like, you were supposed to help me out on my taxes. You're not even helping me out. You're costing me money.
Correct.
So now at least the kids are providing about $2,000 for the year. So if you break that down.
And the daycare credit, what I like to call it, is still in force.
Okay.
it really isn't that generous, but it helps. The cost of daycare is absolutely astronomical. But I believe it's $600 maximum credit that you could get
for the year.
For daycare.
That doesn't even cover 1 month of daycare.
But they've left it in. I will tell you, a change in the child tax credit is once you're above 16, meaning children 17 and over, and again, there's a lot of age barriers on here too. Now your child's only worth $500. So if your kid's in college,
decreases by 75%.
Yes, if your kid's in college there and you're still claiming them as a dependent, that benefit's been reduced to $500.
That's when you need the money almost the most.
Right, but I will say I forgot to mention something. Under the new child tax credit, part of that is now refundable, up to $1,400. But previously, if your income was zero, you couldn't enjoy the full benefit of that credit. Now, the way it's calculated is that depending how your tax situation is, and you get some of that, you can get up to $1,400 of that credit back.
If your income is zero.
Right. In other words, I don't want to get into earned income, but it used to be that if you couldn't enjoy the full child tax credit under the old code, because the way it worked out, say your taxable income went to zero, now up to $1,400 of that is refundable, which is it's nice to get a refundable tax credit.
We'll have to have a conversation about that offline because there's a whole bunch of the what's that I word? Anyway,
the devil's in the details.
Yeah, the devil's in the details, and I have a whole bunch of stuff that I'd like to say about that, but I won't right now. All right, qualified business deduction. Now, this is one of the areas that you want to talk about chapping my hide. Okay. Previously, if you paid money to protect your net worth, so if you hired a CPA, if you hired a certified financial planner, if you hired a business attorney or an estate planning attorney to help you protect your assets, what you paid was tax deductible if it was above that 2% miscellaneous.
That is correct.
Blah, blah, blah.
Yes. My last and final comment on the itemized deduction is just to what you were speaking about. Under the new code, miscellaneous deductions have been, to use IRS talk, suspended until 2025. What that means is you cannot deduct any miscellaneous items on your Schedule A. And that included everything you just mentioned, investment management fees, CPA fees, estate planning fees, but more importantly, unreimbursed business expenses, business miles, business entertainment, which impacts to a negative smaller businesses that could not afford to reimburse their, say, salespeople. Again, if you're working for a large company, they have the funds to reimburse, but if you're a small business, okay, and they can't afford to always reimburse you, the gift was you could deduct that on your return, and you cannot.
Right. And then one of the other big ones that really just, in my terminology, killed me, because a lot of what I do is being out and about. And so there's a lot of meals and entertainment.
Yes.
Right? Tons of meals and entertainment. And not just for me, other people do it on the golf course. That as a business owner, as a business person, entertainment is not always entertainment. Entertainment is a lot of times it's work.
Yes.
It's just that we just happen to be at a cool place while we're negotiating or talking or chopping it up, right?
So,
now,
let me tell you what's going on there. And boy, was this a problem at the beginning of tax, because we could barely understand the rules. So how are we going to explain that to a client? And we did get clarification at the beginning of taxes.
But we couldn't understand the rules because they hadn't been written properly
that
yet.
Is
so
correct.
that's
they always pass things late in the year and they don't think through the details.
Right.
Okay. And as everyone loves to say, the devil is in all the details. Okay. So where we are now, again, if you are an employee, this doesn't matter. Okay. Entertainment, meals, not deductible. That all is clear. Okay. If you own your own business, and again, there are some specific nuances here. Where we are today is meals. Business meals remain 50% deductible. Okay. And the restaurants were very happy to hear that. So if you take a client out or a prospect and spend $200 on a meal, that is $100 worth for your deduction, which is getting you about, say, 35% of that back. Okay?
Now, let's say I have season tickets to the Atlanta Dream, and I decide that I'd like to bring Rob with me to the game this afternoon at 3 p.m.
Well, you want the good news? The good news is your business can pay for it. The bad news is it is not deductible. And they are clear. Golf, memberships, taking people to the ball game, the soccer game, not deductible. And in fact, what you're going to see, Emma, is when you're out entertaining clients or prospects where there's food and entertainment, to be deductible, the IRS has told us the bill has to have the food separate from the entertainment cost.
You knew where my brain. Now, what if I take you to the game and we just buy a whole bunch of food? But I don't like food at the games.
I know, but that's where we are. And again, part of that is due to the abuse in this area prior, because the thing we really haven't touched on, tax rates have come down. Okay, at all brackets, the brackets have been expanded, and the rates have come down 2 to 4% in those brackets, depending where you are. So you giveth, you taketh away. It's hard to find out where people have benefited from this. But if you are a business owner, a lot of these deductions outside of entertainment remain, including miscellaneous deductions, which you would use to run. So my point mentioning this, if you're part of that gig economy and paid on 1099, these are open to you, unlike a W-2 work.
The meals.
The other unrelated miscellaneous expenses.
Okay.
Expenses to relate your business.
Now, since we're talking about business entities and the gig economy, I keep wanting to say jig, but jig is a dance. So if you're part of the gig economy, you are a sole proprietor.
You are.
Okay. So whether you officially create a business entity or not, if you are receiving 1099 income in, meaning that it doesn't come with a pay stub and they've taken taxes out, that's a contractor. That's what we refer to, either you're a 1099 or you're a contractor.
That's correct.
Now, from a taxation standpoint, are there any pros and cons of remaining a sole proprietor? Okay.
Well, let's start with clarifying something. And I have to say I'm not an attorney, although I probably could have been one.
You should have been one on TV.
Yeah. An LLC, and I want to repeat this to the audience, an LLC means nothing to the Internal Revenue Service or the state that you live in. Okay, it is a legal term that provides certain type of structural legal benefits for you to operate your business. Okay, so if you are self-employed in the gig economy or just self-employed, whatever, you are doing a Schedule C as in Charlie on your income tax return. Okay, whether you are or not. Okay. When you do a Schedule C, you track all your business expenses like you would if you're any business, all right? And there are benefits to doing that because under the new Section 199 code provides, let's say, up to 20% relief on your overall net business income, okay, to the business owner. So if you're an Uber driver making 50 grand a year, you potentially would have a $10,000 tax deduction. This is after expenses. And that is the same 20% that would be given to somebody with a $5 million company. Now, it's not easy because there's multiple calculations with wages and things like that, but it's not smoke and mirrors. It's a real deduction.
Now, is this a deduction that, there's people who do the turbo taxes and the Intuit thing and blah, blah, blah. Will they be able to get to that from there?
Yes.
Or yes?
Yes.
Oh,
yes. Okay.
All right.
As a self-proprietor, to answer your question, you would pay your federal taxes, you pay your state, and you would also pay your SE tax, which stands for self-employed FICA, okay, which is convoluted as well because it's twice what you would actually get out of your paycheck if you work for somebody. The IRS has done a very clever, and I do use the word clever, job of hiding that from most people. Your employer matches what comes out of your check. Social Security is by far the most important tax that the federal government Internal Revenue Service, Department of Treasury collects. Although you pay both sides, you do get a deduction for one side, but to your point, Emma, it adds up quite quickly, which is why there could be benefits to becoming an S corporation or C corporation, depending the nature of your business. Are you living on distributions? Is it a capital intensive business? Because one of the big changes in the code is President Trump cut the C corp rate from a staggered rate up to 35% to a flat rate of 21%. Now, what that does is that now says that a lot of businesses that were not a C corp should examine on whether it's beneficial. Okay, there are advantages to doing that, related to medical expenses, related to retirement planning. Okay, yeah. But it's beyond the scope of this. But if you have questions about that, please talk to your financial professional about pros and cons, because it is always different. It is always different, but people should be looking at that. The S corp situation is has always been a tax quote loophole for people, because the government does not, again, the Department of Treasury, income from an S corp is not considered self-employment income, and it is not subject to the SE tax. Where taxpayers get tripped up is what I call greed. You are required to take a reasonable compensation, okay? And the IRS wants that as high as possible, and you want that as low as possible. And you don't want to get audited for that, because it becomes a mess.
And they will never stop looking.
They will never stop. That's all.
Yeah. So what he's talking about a little bit here is, as a business owner, let's say, and we're talking after expenses, right? After expenses, let's say you've got about 100 grand left over in profit, and you want to pay yourself this, right? So ideally, as a business owner, you could pay yourself maybe 60,000, and this is where it gets sticky, and why you have to work with your CPA and your financial planner on this. But one of the things you want to look at is, okay, if I have $100,000, I can take that whole 100 and I can pay taxes on it. But as a C corp owner, right, there's a portion of that money that you can take out as income, and another portion that you could possibly take out as
dividends. Okay. But again, it relates to the structure. So using Emma's example with that 40,000, if you were on W-2 salary on an S corp, okay, say 60, and there were $40,000 of profits remaining, you're still going to pay IRS and your state if there's a state tax, but you're not going to pay that 15.3% FICA, which is a huge savings.
Correct.
Okay. The thing you have to remember is the definition of reasonable is intentionally defined that way because it relates to what you do for a living. Okay. So what is reasonable comp? Okay. What is a reasonable expense? Okay. If Emma was a financial advisor to very rich people in the Middle East, maybe a Rolls Royce would be a reasonable and ordinary expense to pick up that chic. Okay. If you have clients in Greater Atlanta, a lease payment on a Rolls Royce is not ordinary and necessary. So it really does depend. On the C Corp, there's two levels of taxation. Okay. That thing that you have to understand is an S Corp means Mr. IRS or Mrs. IRS, please allow us to tax this income on my own return.
I appreciate you.
I'm trying.
I'm so impressed with you right now.
Well, it's 2019. On a C Corp, that entity pays its own taxes separate from the taxpayer and has nothing to do with your individual income tax outside of the fact that you're drawing a W-2 salary from your business. Okay, but what I touched on, and there are a lot of reasons why you should or you shouldn't, C Corps typically, all things being equal, are best for businesses that want to accumulate a lot of earnings in their company. Something that's very manufacturing, something that's very capital intensive, because as you take money out of a C Corp, you're going to pay a dividends tax on that, which you would not pay on an S Corp.
What is a dividends tax? What is that tax rate like?
The tax rate would be the tax rate at the dividend, which is 20 some odd 20 some odd percent, if I remember right.
Which could be cheaper than ordinary income tax rate?
Well, you're gonna pay the ordinary, you're gonna pay the 21% on the C Corp,
and
okay? But dividends are not tax deductible, so then you're gonna pay it again. So it is a double level of taxation. So, and most of the times, it's probably not beneficial, but again, it depends. If you have high medical expenses or children with special needs, you can put in on your articles of incorporation, can't think of the word, an amendment saying we are going to pay for medical expenses on a pre-tax basis. And medical expenses related to, say, special needs school, that is a totally legitimate medical expense.
And I think, one thing that we also need to go back to is people ran away from C Corps.
That they did.
They ran away from when the tax laws changed, I think it was in the 80s or whatever, people ran away from C Corp because of the double taxation. And they ran to S Corps and they created this thing called LLC. So now we're in this quasi state, and things still need to be fleshed out.
They do.
They still need to be fleshed out.
You need to understand what are you trying to achieve. So right now, everyone loves LLCs, okay? And there are big advantages with LLCs. In fact, my favorite advantage of an LLC is ownership and profit distribution do not create a bucket of money and invest in something, and someone was going to put up the money and someone was going to do the work. Between you and that owner, you can decide how much of that profit will be split accordingly, and you can be 50-50 partners in that business. Okay? In an S Corp, it's simple. Your distributions are based on what you earn. If you're 50-50, by law, it must be split 50-50. And that may not work for certain types of businesses.
Yep. So is there anything else you want to add? This was great. And I know people are going to have tons of questions, so we're going to be posting this. We ran into some technical difficulties this AM, but we're going to be reposting this, and I know there's going to be questions. If people are looking for a new CPA, or if they're looking for a part-time CFO, how do they reach out to you?
Well, you can, our website is flgacpa.com, and all our contact information is on the website. If they work with you, Emma, or whatever, they can contact you locally here in Atlanta. Our number is 770-804-6403. That's 770-804-6403.
You do realize that there's no more local, right? That even no matter where they are in the nation, they can still dial that number?
Right, but we also have a 1-800 number, number.
If you are here in the Atlanta area.
My final comment.
Somebody thinks you're great.
Okay.
Brad doesn't.
My final.
That's different. That's
my final comment here
He's biased.
Is everybody should be doing some level of tax. Whether you're a lower income and can qualify for earned income credit, whether you're starting a business, whether you just bought a house, whether you're expecting your first child, this planning needs to be done during the tax year, not in tax season. The thing we hear all the time is, Rob, my CPA doesn't communicate with us. We can't reach them in February. I'm like, if your CPA is worth anything, you're not going to be able to reach them in February.
Or March.
Or March. And at that point, there's very little we can do for your prior season. Things are baked. And this is a subject that people don't like to talk about. So they put it off, and then candidly, all the holidays are typically at the end of the year. And then even with best intentions, they don't get to the accountant or CPA until January. And then we're frustrated and the client's frustrated because there isn't much you can do.
And then you frustrate me because you're asking me to jump through hoops to get stuff done. So
and
the best time to plan for this tax season, so we're in 2019,
is really the fourth quarter when you really know where your numbers are going to be.
Right. And then you still have, now for business owners, I'm going to say it's a little bit older. It's going to be that third quarter because we still have opportunities to shift a couple of things, start retirement plans, etc.
Correct.
So for business owners, you should really be looking after you file your taxes and do everything in April. Take a breather, let your CPA take a breather, let everybody's brain kind of get back to normal, look at what just happened, but then start thinking, okay, we didn't like what happened in 2018. Now what do we need to do for 2019? And the time to figure out what to do for 2019 is not in 2020.
That's right. And one final last comment, there are a lot of benefits to being self-employed. When you're a worker, okay, they take your income taxes out of your check. And at the end of the year, plus or minus, all things being equal, you settle up with the IRS in the state of Georgia. Okay, when you're self-employed, the IRS requires you to make quarterly estimated payments. Okay, they are not giving you to the end of the year to pay your income taxes, and there will be penalties involved, and it's specific. You have to pay in a certain amount during the year. And if I could give one last plug to Georgia residents who have young children, they have improved the 529 deduction at the state level. Okay, so if you are a married couple, you can now do $4,000 a year per beneficiary.
So per child.
Per child, thank you. Okay, on your Georgia tax. So if you have 2 or 3 kids and you're able to do that, that is a nice deduction that you could have. And that's $2,000. And if you're single, obviously it would be $2,000, not $4,000. And that was legislation just put in a
So
couple
if you've
years
got
ago.
2 kids, you can put $8,000 away?
$8,000.
Oh, wow.
Well, you can contribute more, but the state of Georgia will give you an $8,000 reduction of income. That's $480.
Is that just for the Georgia plan?
That's only for the Georgia plan, okay? And your client should speak with you on whether you like the Georgia plan or not. I candidly will tell you, when my daughter was very young, I did my homework and I liked the New Hampshire plan the best. But that was at the beginning of the 5.
I was like, that was a long time ago.
So you have to decide whether that benefit outweighs the investment options in your state.
And just
plan.
because you do you can do a certain amount in the Georgia plan and then the rest of it in another
That's
plan.
possible.
Because
That's
to
why
Rob's point, to Rob's point, there's certain 529 plans that are going to rock better than others. So Rob, I want to thank you.
Thank you so much.
I want to thank you for coming in, and I'm definitely going to have you back.
I appreciate it.
All right.
I enjoyed it very much.
And we'll be back in 2 minutes with my top 5 news stories of the day and also market movers and losers.